So thank you for joining us this morning. My name is Mary Jo Katras, and I am with University of Minnesota Extension. And we are offering our Taxes 101 webinar series. This is the second webinar in a series of 3 in partnership with Lutheran Social Service, Prepare and Prosper, and Mid-Minnesota Legal Aid. And for those of you that have joined us in the past, we have been doing this for over 15 years. And so some of the our partnerships have remained pretty stable throughout those years, but the faces have changed. And so we are just excited to be able to support this education and help support families and service providers as we enter into this tax year this year as well. So like I said, this is the second webinar in a series of 3. So this webinar is Tax Implications of the CARES Act and COVID-19 for tax year 2020. We do have our third part 3 webinar coming up on January 26th at the same time, and that will be focused around free tax preparation, credits, and deductions. And we will put the registration to that in the chat later on throughout the webinar. Just a little housekeeping before I introduce our speakers for today. And I think I shared this a little bit at the beginning, but some of you are still coming on, is please stay muted throughout the webinar just to diminish some of the noise and extra kind of things happening so we all can hear. This is being recorded and it will be sent out after the webinar along with the slides. And we also have a resource guide that we will share as well. And we'll also share that in the chat as well. If you have questions throughout, we'll be taking them at the end, but we will be monitoring the chat for those questions as well as anything you need throughout the webinar that we can be helpful with, that we can help with. So without further ado, I will turn it over to our presenters for the morning. And our presenters are Aisha Savati from Mid-Minnesota Legal Aid and Eric Beaudry from Mid-Minnesota Legal Aid. So I will turn it over to them to introduce themselves and to start with the webinar. So thanks again for joining us.
Thank you so much, Mary Jo. Eric and I are with Minnesota Legal Aid's Low-Income Taxpayer Clinic. I'm the clinic director and Eric is a staff attorney and Skadden Fellow. And so I do have our contact information here and it'll be later in the presentation as well. And then just noting our other partners that we have with us, we have Mary Jo, we have David Lange for Prepare and Prosper, and Shauna Thompson for Lutheran Social Service. Eric, I don't know, do you have anything specific you'd like to highlight? Eric's working on a worker misclassification project, is what his fellowship is around. It's very exciting. So our kind of last bit of this presentation will be him talking about that and COVID-19 and the gig economy in ways that we're taking cases around that.
Thanks, Mary Jo, for the introduction. As Aisha mentioned, my name's Eric Beaudry. I use he, him pronouns. I'm a staff attorney and Skadden Fellow with MMLA, and I'll be talking to you all for about the last third of the program. But for the first 40 minutes or so, it's all Aisha.
Excellent. And so I'll go through our agenda a little bit. So kind of breaking it down, we're going to be talking about the COVID-19 legislation. So we have the CARES Act and also the most recent Consolidated Appropriations Act and kind of what those kind of brought to the forefront. Our focus is on low income and middle income taxpayers. So kind of looking at those specific provisions related to them that would have the most impact on our clients. Looking at COVID-19 and tax year 2020 returns, specifically kind of the IRS's response to COVID-19 and kind of ongoing issues that we're having with communicating with the IRS. Economic impact payments being a big highlight and things on people's mind coming out of the CARES Act and then continuing through the Consolidated Appropriations Act, talking a bit about unemployment insurance and compensation, and kind of that's a big ticket item on 2020 tax returns, just for people potentially having increased liability if they didn't have taxes withheld. And then some additional tax considerations with other provisions of the legislation, just kind of going generally over those and providing a little bit of information. And then talking about Eric, the worker misclassification and the gig economy specifically. And so looking at that COVID-19 legislation, we have the CARES Act and then the Consolidated Appropriations Act of 2021. And so the CARES Act, as I'm sure many of you are familiar with, was passed on March 27, 2020, providing relief for individuals and businesses that were negatively impacted by COVID-19. There were, of course, many provisions to that legislation. Some of the ones that were highlights for a lot of our clients that we were working were the direct payments to individuals through those economic impact payments, otherwise known as stimulus payments, expanded unemployment. So having additional individuals be eligible for the unemployment, based in their state, and then receiving those additional monies of $600 and then $300 each week. Some small business relief, which I'll talk just briefly on. And again, if people have any questions about anything as we're going along, putting them in the chat, and then also, my information is available there for you to email if you have specific questions related to a client matter, and also referring clients to our clinic. Additional assistance to hospitals and healthcare for getting that funding that kind of goes in as well with the COVID-19 testing, so provided that free testing for individuals. And then state and local government assistance for additional monies to fund those programmings in response to COVID-19. And there was a lot of programs. I know many of you probably have clients that have benefited from the state programs and local programs to individual cities providing relief. And I know a lot of rental assistance, healthcare insurance assistance, and different things like that were expanded due to COVID-19. And then we have the Consolidated Appropriations Act of 2021. So that was just signed into law December 27, 2020. It actually contains multiple parts. It's legislation that is over 500 pages long. So it's a lot to kind of go through, but it includes the COVID-related Tax Relief Act of 2020, and then the Taxpayer Certainty and Disaster Tax Relief Act of 2020. And kind of what we're going to highlight about that is allowing the second round of direct payments to individuals and kind of actually expanding eligibility for that. Also looking at the federal pandemic unemployment compensation, so continuing that compensation through March of 2021, and then additional small business relief and clarifying some of that small business relief that was in the CARES Act by this act. Another thing I want to mention, and it's kind of a plug for our next webinar as well, is that something that came out of the Consolidated Appropriations Act was that taxpayers may use their tax year 2019 earned income rather than their 2020 income for purposes of the earned income tax credit and the child tax credit eligibility if 2019 is greater, which is, amazing option for many of our clients, those that because you need earned income for those credits. And many of our clients would actually not be eligible if they had no employment this year, or very limited on like earned income employment. And generally speaking, the unemployment itself isn't earned income. And so kind of having that availability for our clients, and we'll talk more about the earned income tax credit and child tax credit in webinar 3, but I just want to put that on people's radar because that is a big thing that came out of the Consolidated Appropriations Act that affect our clients. So looking at the IRS response to COVID-19, what the IRS did was called its People First Initiative, and it passed that at the end of March and continued through July 15th, 2020. And so what it did is extended that filing deadline for individuals. And so people did not have a penalty if they filed after April 15th, 2020, as long as it was filed by July 15th, 2020. It also allowed the normal extension through October 15th of 2020 for individuals to file and pay any taxes due. They also temporarily suspended many IRS notices. So a lot of people that might have debts owed to the IRS wasn't sending them the notices saying, hey, pay us, that they send in a series. And so they suspended that. There is an ongoing issue with that, which I'll talk about in a moment, but they did suspend that. So people kind of weren't receiving those notices and freaking out of, oh my gosh, what am I going to do? It says I owe the IRS. I don't know what to do here. And it also suspended certain levy activities. And so that was kind of a big thing, especially for our clients in the LITC, is many of our clients, the IRS will automatically levy against their Social Security benefits, their employment income that they might have, put liens against property. And so IRS suspended many of those activities, which definitely helped a lot of our clients. It also delayed certain collection alternative actions. So it allowed you, if you were in an installment agreement, they allowed you to put your payments on pause in 2020 without having a consequence for doing that, without defaulting out of your installment agreement. It also allowed people extended period of time to provide documentation for offer and compromises, which is a way to settle the debt for less than the amount owed. And then it also made it so that they were granting more relief under temporary collection suspension based on economic hardship, showing that you don't have your necessary monthly expenses exceed your income for the month such that it would cause economic hardship for you to attempt to pay the IRS. And another great thing that happened out of it is it temporarily suspended private debt collection referrals. So what the IRS does is there are 4 private debt collection agencies that the IRS refers its debts to that are past a certain point of collection, and they pass them over to those private debt collection agencies to attempt to collect against the individual. The money is still owed to the IRS. The individual is still to only pay the IRS. So that's kind of a distinction. A lot of people get confused about that. But the debt is with the IRS. It's just they kind of put the collection activity onto someone else to assist them to collect the money. And that is something, if you do have a client that's in a situation with a private debt collection agency, currently, since that temporary suspension ended approximately in July, and if they are in that situation, again, they can contact us and we can help them put at least a freeze and on that, a cease communication letter, so that they're stopped being contacted by the private debt collection agency, and then having their debt referred back to the IRS so that you can talk about collection alternatives with them. Some ongoing issues that came out of this is when the pandemic first started, the IRS essentially shut down all of its operations. The telephone lines weren't available. The majority of its campuses were closed down. So there was no way of getting through to the IRS. And so that was so the People First initiative was in response to that, saying, okay, we understand you can't get a hold of us. We're shut down. So what we're doing is we're kind of freezing a lot of our activities that would be adverse to you. And so the issue is many of those campuses and units are still closed, and the telephone line for the IRS, there's limited phone numbers now that are available, extremely long wait times, as there already is with the IRS, but even more, and a lot of people get their calls dropped. And so there is the issue with people who are now receiving notices from the IRS. What can they do to respond to them? Because the issue is the IRS notice says you have 15 days, you have 30 days to do this or else. And people get very scared, naturally get very scared by these notices, and they're unable to get a hold of anyone at the IRS. And then the deadline passes and they don't know what's going to happen. And another issue, again, is related to limited telephone support. Even the lines that are available for tax professionals, there's a priority service tax line. If you go on the IRS website, Industry Practitioner Priority Service, you'll get the phone number available for that. Even that, for us professionals assisting clients, is still not having telephone calls answered. People haven't been able to get a hold of them specifically in the last 3 weeks. So that's causing issues in our representation of clients even. Another issue is the IRS mail. And so the IRS did not process mail for several months. There are actually huge loading trucks just sitting there full of mail to the IRS. The IRS still has over 7 million pieces of mail it hasn't gotten to. And so a lot of times, already there's slow processing in the mail and tax returns. So people that did even 2019 tax returns that might still be sitting in a pile and haven't been processed yet. There's also people that have written in response to correspondence from the IRS, people that have done requests for relief with the IRS, people who have even sent in payments for their tax debts. The mail is just sitting there and hasn't been processed yet. And that's going to continue into this next tax season. There'll be a delay in issuing tax refunds. The IRS has kind of already stated that there'll be, normally it's 21 days to process and even an online tax return, and that might be delayed. And then it's usually 6 weeks to fully process a mailed in tax return, and that may be even delayed. And then there's also the delay, like I kind of mentioned, in processing of payments. So people that send payments in with their tax returns or after the fact, a lot of people send that by a check to the IRS, and that's sitting somewhere, and then time goes by and the bank may even cancel that check because it hasn't been processed yet. And so a lot of people are wondering, what do I do about that? And then the delay in responding to correspondence will just continue with the IRS. And so a lot of people, don't understand even that it takes several weeks to months for the IRS to process things anyway. And now when you're looking at this large of a delay, the IRS is saying that all of its mail is generally over a 60-day wait time in general for its correspondence. And then notices being sent with expired deadlines. When the IRS first started sending out notices, they didn't reprint the notices. So they sent notices that would be dated in March, April, generally was the last time that they were printing them, because they print them ahead of time to send out. And then the person receives it and it's dated from several months ago. It has a deadline that has long passed, and this is especially important with people who receive notices of deficiencies, because that's the only way they can go to tax court. And so the IRS was supposed to send in a little sheet of paper with the notice saying, hey, this was sent, after this was printed, this is your actual deadline now for responding. The issue is those weren't sent out with a lot of the notices. And so people were still confused about what was going on. Do they owe the IRS? How much do they owe? What's going to happen to them? And so we have a lot of issues with, people not knowing what to do in general with mail from the IRS. And now even more so, there's a lot more confusion and a lot of misunderstanding about what it means to contact the IRS even. And so now I'm going to jump into talking about the COVID-19 legislation and provisions and how they impact the tax returns for 2020. And so a large part of what I'm going to be talking about is economic impact payments. That was something that affected every individual, essentially, not even just taxpayers, but individuals. And so what it was is an advanced refundable credit for tax year 2020. The eligibility is you need to be a US citizen or resident alien. And so there are tests to do to determine if someone is a resident alien. And so they need to be able to meet those tests of being in the country if they have, certain documentation, or if they have certain visas or green cards, needing something like that in order to establish that they are a resident alien in 2020 in the US. Another key provision that has caused a lot of issues for people is you cannot be claimed as a dependent on someone else's tax return. And the issue is that a lot of people may have been claimed in 2018 or 2019 when the first round payments were based on those tax returns, which I'll talk about. And so they might have been claimed as a dependent by someone, and therefore they were ineligible for the economic impact payment during that first round. Now, people that were claimed as a dependent, there is the opportunity for them to file a 2020 tax return, which I'll talk about. But the key thing is that you cannot be claimed as a dependent. And technically the wording, even in the statute, it's cannot be claimed. It's not, was not claimed. So there are potentially issues with people that, technically qualify as a dependent on someone else's return, but weren't claimed. Are they then due their economic impact payment? And what we've been telling people is to still apply for the economic impact payment and see what the IRS does in response. Another key part is that you need a social security number, and not just a social security number, but it also must be valid for employment. And so we do have some clients that are given social security numbers, but they don't have that specific designation of valid for employment. And it does need that according to the CARES Act legislation. And during the first round of payments, everyone on the tax return needed a social security number. So those individuals who do married filing jointly, one spouse has a social security number, one spouse has an ITIN number, they did not receive the first round of economic impact payments. Now, with the Consolidated Appropriations Act of 2021, those households are eligible for economic impact payments, and it does relate back to the first economic impact payments round. And so those individuals are now eligible. That, I should say, the household is eligible. Technically, you still need the social security number on to receive an economic impact payment. So generally for those households, the spouse with the social security number, and then if they have any dependents with social security numbers, you would receive payments for that number of individuals. Now, if there is a household where both parents or both taxpayers listed on the return are ITIN holders, and the children have social security numbers, they're not eligible for payments. The one of the taxpayers must have a social security number. It cannot be just based on the dependents, because again, they are dependents, so they themselves are not eligible. And then you must meet the adjusted gross income thresholds of individuals of $75,000 or less to get the full amount, $150,000 for married filing jointly. And then it does the amount goes down up through the $99,000 and the $198,000 where you would receive no economic impact payment. So it's $5 less for every $100 over. And then another key provision of economic impact payments is that they're not considered income. And the important part of that is it's not considered in your taxable income, but it's also not considered income for public benefits purposes. So people don't have to worry about receiving that money and becoming ineligible for the benefits that they're receiving. And the only offset that is allowed is for past due child support arrearages. And so people that owe the IRS already, their money was not captured and applied to those debts, which is usually what happens with refundable credits when you file a tax return. Also, and this was solidified in the Consolidated Appropriations Act of 2021, is that debt collectors should not be able to kind of capture those funds as well and apply it to any debts that you have outstanding. And so there was kind of uncertainty about whether that was exactly going to happen with the first round, but it was solidified in the second round. And so this just looks at an overview of the two rounds. Again, it was $1,200 for the first round per individual and $500 per dependent. Second round was $600 per individual, additional $600 per dependent. So that amount did go up. I do want to take a moment to define dependent. And so how the dependent is technically defined is as a qualifying child age 16 and under. And for a qualifying child, they have to have relationship. You have to meet a relationship test. And the IRS has if you just typing in qualifying child on the IRS website, you'll get great information about meeting the certain tests. And we'll talk more about that in the third webinar, because that goes directly to the dependent credits that you can claim on a tax return. But just generally speaking, you have to have the relationship, you have to have residency, that the child lived with you 6 months and 1 day or more out of the year. And then you also need to show that the child doesn't support themselves it doesn't provide more than half of their support, and that they didn't file their own tax return. And so, key part of that is the 16 and under as well. And with the first round, it was based on a 2018 or 2019 tax return. So if the child was within that age range on those tax returns, you got the amount. If they are older in 2020, you do not owe back the money. That was another provision in the CARES Act. And so people can keep that money even if the dependent wouldn't be eligible in 2020. They just can't claim them if they didn't get it in the first place on a 2020 tax return. That first round was based on 2018 or 2019 tax returns or information provided by SSA. It's based on a 2019 tax return or information provided by the SSA for round 2. And so again, people's incomes were also used for eligibility based on those tax returns. So if their income is less in 2020, they again can claim it on a 2020 tax return, which I'll talk about. An option for people that did not file tax returns during the first round was the IRS non-filer tool. That is something that our LITC assisted with people completing. So people with no income or limited income that's under the filing thresholds, which we'll talk about in our third webinar, just plugging that. But people were able to use the non-filer tool, provide their information to the IRS. It generated a simple 2019 tax return, and then people were able to get their payment based on the information being sent to them. So payments were sent during direct deposit, paper checks, and then a limited number in round one were with prepaid cards, which a lot of people, were like, is this real? Is this a scam? And the IRS tried to do a lot of education around that, but it does come as a prepaid card from the Treasury Department. It'll indicate that on the mail. So people should not throw it away. If people do, there is a way to get a new card if none of the monies was spent. And an increased number of payments are going to be issued through those prepaid cards in round two. They're estimating about 8 million of them will be through those prepaid cards. So we're just recommending that people watch their mail for those paper checks and those prepaid cards as options if they didn't include direct deposit information on their tax return that it's based on, or they didn't provide it in the non-filer tool, which a lot of people weren't able to do because they don't have bank accounts that they can do that with. And so people just be on the lookout for that, because people will often ignore it, throw it away, and it is difficult to try to get things reissued by the IRS. You have to call the IRS and speak with them and go through a series of questions, and then looking into it and seeing if they can resend you a new one. If people do lose it, there is also the option of contacting the IRS and getting a new one if it wasn't cashed yet. And so the IRS issued over 160 million payments in round one, and already in the first 2 weeks it issued, and that was over 7 months. Already in round two, they've issued out over 100 million payments just in the first 2 weeks. The IRS is hoping to have all round two payments out by the end of January. And so where this comes into play on the tax return is with the recovery rebate credit. And what people can do is first track their economic impact payment using the Get My Payment tool. All that's available with the Get My Payment tool now is to track the status. And a lot of times they will get a message saying not enough information is available, and it won't show. Generally, if it goes through, it'll show this payment is going to a bank account that ends in this number on this date, or the check was mailed on this date. And there isn't an ability to change direct deposit information or to change address information directly through the Get My Payment tool. And so what people can do is, if they're getting the notice that non-information is available, they should wait and see if they still receive it in the mail, because a lot of people are getting that message, and it still does show up. But if people don't get their payments, then they can claim those amounts on a 2020 tax return on line 30 as the recovery rebate credit. And what people are going to do is the IRS sent a notice 1444, to everyone that people were supposed to keep. A lot of people didn't, but people were supposed to keep them for their tax record, showing the amount of the EIP that was issued. And so what happens on the, this is an example of the example instructions for the tax year 2020 return. The final versions aren't available yet. The IRS should be issuing those in the next week or two so that people can use them for filing their tax returns. But what you do is you look at the notice, you look at the amount that you received, you look at the amount that you are due, and if there's a difference, you write that on line 30 of the tax return. So if people don't receive their payments at all, if an individual didn't receive any of their payments, then they would have the $1,200 plus the $600, so they have $1,800 that they would write on that line as a refundable credit, which we'll talk more about in webinar 3 in more detail about the recovery rebate credit. But that is something. Or if some individuals received their amount and only received an amount for, let's say, 1 out of 2 children. I'll go a little bit into that more, but generally speaking, if they are eligible to claim the child, then they can do the difference of the $500, and if they didn't receive it the first round, and then the $600 for the second round, so $1,100 on that line, for example. these are some issues that we get a lot of client questions, like what if I didn't get my EIP or it was less than I believe I am due? And these are just some questions to think about when you're talking with your clients is, did they use a refund anticipation loan tax preparation service? If they did, the payments are being sent to them. The IRS is supposed to be fixing that right now and reissuing them to the individuals. But that is causing a delay in receiving economic impact payments if someone claimed them as a dependent. Now, if no one's claiming them in 2020, then they can file a 2020 tax return and claim their amounts, is what we're recommending people do. And the IRS should be issuing those amounts. There is, did your address change? Because the payment's going to go to the address that was on the last on file with the IRS. And people can update their address with the IRS directly. They can update it with the post office to have mail forwarding as a way to get their economic impact payments. If they're homeless and they don't have access to whatever address that they had, or they don't have a steady address, then we were recommending a lot of people. We were able to do some like PO boxes. We were able to do some just general delivery to post offices for people to get their payments, and people did receive them that way. If your filing status changed, then you want to look and see if you are eligible if you didn't receive a full amount. Another issue we're having is with legal separation, divorces, domestic violence victims, and whether or not they receive their payments. And it's a tough one because, some people, and this kind of goes in with, did you take turns on claiming the children on your tax returns and things like that. And the IRS considers that a civil legal matter in family court. It's not an issue for them. They issued it based on the information that they had, and they're going to issue one payment. We are recommending that if people were the ones who are eligible to claim the children for 2020 and they did not receive the dependent amounts, to claim them on a 2020 tax return and see what the IRS does. The IRS could deny it. They could issue it. They could also deny it and freeze your refund, in which case you'll get IRS notices, and then you can contact the IRS and argue your case. And theoretically, if it escalates up, you would get a notice of deficiency and be able to go to U.S. tax court. It's all kind of theoretical because we don't know what's going to happen, but there are options. So we're recommending that people at least try to do it and kind of see what happens from there. If your spouse owed back child support, then technically your half of the payment should be yours, but the other half does go to child support arrearages. The IRS had an issue with the first round where they were sending the full amount to child support offices, and they were supposed to be correcting that and reissuing the half to the other spouse. And then if your child did file their own tax return in 2018 or 2019, then you wouldn't be receiving that dependent amount. If the spouse passed away in 2018 or 2019, then you shouldn't. Sometimes some payments were being issued and you were supposed to return those to the IRS. And then if your spouse was incarcerated, so at the beginning, the IRS was saying that incarcerated individuals weren't eligible. And then at the end of September, there was a court decision saying no, incarcerated individuals are eligible, and that ruling has stood. And so incarcerated individuals are eligible for the economic impact payments, and they should be claiming those on a tax return. And I put the EIP hotline. People have been able to get through to the EIP hotline generally. And that's for if people have questions about doing a payment trace to see, I didn't get it, where is it? Or if people have questions about eligibility or, did I receive the full amount, they can call the EIP hotline. I'm going to be now talking about unemployment. And so what kind of generally happened is that, it's determined by the state of Minnesota for us, on whether or not you're eligible for unemployment. And then what was issued was the additional $600 of payments initially. And then, it went to $300 per week, and then continuing on with those $300 per week, with individuals being eligible for up to the 24 weeks of unemployment. And so I provided some of the links on these slides have links directly to the Minnesota Unemployment Office. And so you can get more information directly about that. But kind of what I'm talking about more is the tax implications. And so unemployment is taxable income. A 1099-G is issued. It should be issued with the full amount received. So that initial base amount, as well as those additional $600 and $300 that we receive per week. Now, Most individuals, when they were signing up for their unemployment, did have taxes withheld automatically from their base payment. The issue was the unemployment offices were not automatically withholding the amounts for the weekly supplemental payments. And so this is a huge issue that I anticipate us seeing with our clients, is people for the first time are going to see themselves owing the IRS because they were receiving, $2,400, for example, every month of untaxed income. And so if people, are single filers and they don't have dependents to try to offset some of that liability and didn't take steps to have voluntary withdrawal to make estimated payments, if they didn't receive new employment that they could kind of balance things out, then they're going to owe the IRS. And so what we recommend is that if that is a situation for your client, you send them over to an LATC, which I'll have on the slide, the information for the LATCs, and we can talk to them about collection alternatives and options that they have, so that if they're unable to pay the tax liability when it's due by the April 15th deadline, then we can help arrange it so they can, based on their situation, what collection alternatives work for them so that the IRS doesn't try to levy against them, essentially. So options to decrease that potential tax liability for your clients for this tax year. Unfortunately, there isn't really anything you can do for 2020, but for 2021, you can do an IRS W-4V, which allows you to voluntarily withhold 10% federal taxes. And I haven't seen anything that's the equivalent for the state of Minnesota. So people may still owe for the state of Minnesota, even if they have a voluntary amount. Generally, you withhold 15% for federal and 5% for states, or a total of 20%. What people are able to do is make estimated tax payments, and you can do that through the IRS direct pay. You can also do it through the state of Minnesota on their websites. And what you're doing is you're stating the tax year that you're making the payment for, and you're stating the amount that you want to pay. And so people there are estimating calculators for amount that you should be having withheld or amount of taxes due based on your income. So you can use those estimates to then come out with a payment. Generally, with people who are self-employed or small businesses, they make payments on a quarterly basis. You can make multiple payments at any point. The issue is that, if you don't end up paying enough overall, you are still going to have that tax liability. Another option is for people to increase their withholding amount when they acquire new employment. And so people that, might normally withhold at a 2 or 3 level, if they have some dependent credits and things like that, or if they normally even do a 1 to withhold at a 0, or you can actually set the amount that you want withheld from each check. Which again, we recommend people, go to the IRS website, do that withholding tax calculator, or talk to one of their tax preparers, even talking to their tax preparer if they go early on to prepare their taxes. For 2020, they can talk about what should I do for 2021. And then I just want to briefly just kind of note these additional tax considerations. A lot of the information, you can just look at the slide to get it. But for the home office deduction, it's not available for W-2 employees working remotely. So I know a lot of people are going to be like, hey, am I eligible for this? I mean, I'm working at home, I'm working out of office. Shouldn't I be able to claim a deduction for that? And it's no, you can't do that. Another thing that I anticipate seeing with clients is looking at hobby income. Now, and I think the classic example is people who are making masks and selling them on Etsy or selling them on Facebook. And technically, hobby income is reportable income for individuals. And what you do to distinguish between a hobby and business, which is important, a lot of people won't classify themselves necessarily as a business because there's a 9-part test and you often carry on for 3 years, when you're thinking about yourself as a business. But, the primary purpose test is, a hobby is an activity not engaged in for profit. That isn't your main purpose in doing it. Your purpose in doing it is doing it because you enjoy doing it. And if you see a little bit of a profit, that isn't your intention, though, to make a profit. So a lot of times, people, they're selling the masks for essentially the materials that were put into it. What you can do is you can deduct expenses up to the amount of your income for a hobby. But what you can't do is claim a loss. A loss is only for businesses. And I have on the slide where you can report those on a tax return. Again, I recommend people talk to a tax preparer about it and be open and honest with their tax preparer about the income that they've had and activities that they've had, and report any income that needs to be reported. In our third webinar, David from Prepare and Prosper will talk more about tax preparation and finding a tax preparer that can help our low income and middle income clients. Another thing to note is interest on tax year 2019 refunds. The IRS, because things were delayed, they did delay a lot of issuing out refunds. So there was interest paid. If someone received $10 or more as interest, it is reported income. You'll get a 1099 interest, and you do report that on your tax return. It's similar to how you often have to list what your state tax refunds were on your tax returns as well. Just another thing to know about COVID-19 retirement plan distributions, there is no 10% penalty for distributions up to $100,000 due to COVID-19. It is subject to income tax, and it is being looked at over a 3-year period. And then talking about above the line charitable deductions. So normally you do charitable contributions as part of your itemized deductions. This year there is an above the line charitable deduction of $300 for a single, $600 for married filing jointly. And you will list that on your 1040. There's a specific line. The 1040 is available for 2020, so people can look at it. And the software will be updated and everything to have that ready to go for people to start preparing their taxes at the end of January. And so people are able to take that as an above the line one and be able to take the standard deduction amount. And then I just want to note the Paycheck Protection Program. And with that, you know, the LITCs in general, we don't do too much with small businesses, but I did want to mention it because it is a huge part of the CARES Act and the Consolidated Appropriations Act, which did modify a little bit. And so there were loans being made to small businesses, self-employed individuals to pay certain costs. And there is a list of qualified expenses, and they were expanded so that it wasn't just payroll. It expanded to things related to closing down of businesses, things related to property loss or damage during COVID-19, and just different categories, you know, allowing you to look at certain services that you offer or contracts that you were in. There's a whole list, and I did the link at the bottom is to the U.S. Department of Treasury that talks more about the Paycheck Protection Program. And I definitely recommend people, there's some great fact sheets on it. People look more into that. If you have a client that is self-employed, you know, especially, or is part of us that has a very small business, maybe they have 1 or 2 employees, looking at that to see, because there is a first and second round of loans, and the full amount of loans are forgivable. There's a form that you fill out because whether or not you receive you know, the amount of time that you receive the payment over, there's a specific form that you fill out. They're not included as taxable income. And then with the Consolidated Appropriations Act, expenses that were paid with the loan proceeds that are forgiven are also tax deductible. So originally under the CARES Act and the way the IRS was you know, processing things was, well, you can get that forgiven. You know, the loan proceeds won't be taxable income, but you then can't deduct the expenses that you paid with the loan proceeds because that's, you know, like almost essentially double counting something. But now Congress is like, no, our point was for businesses to be able to deduct the expenses, even if they were paid with monies received from a loan. So again, I refer people to the Department of Treasury looking at the Paycheck Protection Program. There is a lot of information about it. And so if it's specific to your client, I really recommend looking into that more. And I just want to mention there is legal assistance available. I do recommend, you know, if you want to learn more about Mid-Minnesota Legal Aid, contacting myself and getting more information about it. Also, the resource guide lists information about MMLA and the LITC. So I definitely want to recommend people refer to that and refer to the resources in there for IRS websites and other like United Way and different different resources for individuals relating to like getting tax assistance. There's also an LITC at the University of Minnesota, and they have, it's a clinic program for students that are representing individuals just as we are at MMLA. So I recommend, you know, there are two options for getting that legal aid assistance. We do IRS issues and related state tax issues, but it can't be state tax only. There is the Volunteer Lawyers Network that does do state tax issues on a limited basis. So that is an opportunity, but we do not prepare tax returns. That's the biggest thing. We don't prepare or file tax returns. And again, we'll be talking more about that in webinar 3. So now I will turn it over to Eric to talk about worker misclassification and the gig economy and everything going on with COVID-19.
Thanks, Aisha. Before I start, we do have a number of specific questions related to tax-specific items that arose during your presentation. Do you want to take a few minutes, maybe just to quickly address those before we steer off towards some new subject matter?
I can take a few questions right now if there's a few that are common questions that people had, and then we'll kind of address more of them at the end.
I think Mary Jo is possibly tracking them as we go along. Mary Jo, are there a couple that you think we could just insert now?
Yes. Let me just, I've been tracking them. And so if your question doesn't get answered, we will follow up with these. So just to let you know that too. So one of the questions was, if your child was born in 2020, how do you claim the dependent impact payment if it was not sent to you because the child was not on the 2019 taxes?
Yep, so you include them on line 30 of the 2020 tax return. So you'll just include the amount that you are due for both economic impact payments.
Okay. Thank you. And then another question was how to file stimulus monies on our tax return.
So the economic impact payments that you received are not taxable income. You will not be reporting them on the tax return. You're only reporting if you need a credit still due to you. So if you received all the economic impact payments that you are eligible for, then you won't be reporting them anywhere on a tax return.
Okay. And then the last one, I think, and then we can move on, is how or are non-filers unable to submit the non-filer tool based on the prior deadline now that the second round of payments are going out?
Yeah, there is no non-filer tool for this second round, unfortunately. And so people that didn't do the non-filer tool and don't otherwise file tax returns will need to file a 2020 tax return in order to get their second economic impact payment, or even their first one if they didn't do the non-filer tool or didn't receive it yet. So the IRS is essentially saying anyone that doesn't receive their economic impact payments by the first week of February 2021 should file a 2020 tax return and claim them on line 30. And so we'll talk about in webinar 3 about free tax preparation services, but generally VITA and TCE sites are available to assist with that. So people will want to go to a VITA or TCE site to get help filing a tax return.
Perfect, thank you. There's a few other questions, but maybe we'll answer some of those in the chat as we go as well. So now I'm going to turn it over to Eric so he can do his piece. Thank you.
Great, thank you, Mary Jo, and thank you, Aisha. Hi, everyone. Again, my name is Eric Beaudry with Mid-Minnesota Legal Aid. We're going to spend the next 20 minutes talking about an issue at the intersection of tax law and employment law, specifically worker misclassification. We're going to zoom in then on sort of one specific instance of worker misclassification, namely what's happening with the gig economy. We're going to talk about how COVID-19 has impacted gig workers and then leave you all with some takeaways. But to start, we'll identify what we mean when we say worker misclassification. The United States Labor Code arose out of the recognition that capital owners and laborers had an imbalance of power when it came to setting up labor contracts. And without setting forth a minimum acceptable standard for labor contracts, laborers would, under coercion or pressure or the simple economic need for survival, accept labor contracts and labor conditions that were substandard or below what society recognizes as minimally acceptable. So because of that, our labor code classifies anyone who's called an employee under a work relationship and gives them a set of benefits and protections that ensures any labor relationship is meeting that minimum set of standards. There is, however, a set of labor relationships that the Labor Code views as entering the negotiation process on equal playing fields. Those are what we call independent contractors, and typically independent contractors are those who are running their own businesses, who have an equal opportunity for profit and loss. And the Labor Code looks at that and says, these independent contractors have a fair bargaining table already. They don't need those protections like minimum wage and overtime and anti-discrimination. And so we're going to exempt them from the set of protections that we're going to give to employees. So why does it matter? Whether one is classified as an employee or an independent contractor comes with consequences related to expenses, protections, taxes, and bargaining power. So with respect to expenses, if you're an employee and you spend money on your job to, say, buy supplies or pay for gas, and your employer doesn't reimburse you for those expenses, after 2019, you no longer get to take deductions for those expenses on your tax returns. On the flip side, if you're an independent contractor running your own business, you're going to take deductions as business expense deductions on your tax returns. And as of the Tax Cuts and Jobs Act, you're also going to get a 20% deduction on your qualified business income that you got out of your business. So just at the base level of expenses, independent contractors do have more opportunity to take tax advantages with respect to expenses. But then the other three categories, protections, taxes, and bargaining, all sort of shift towards the side of benefiting employees to make up for that power imbalance. So with respect to protections, employees, of course, get guaranteed minimum wage and overtime. They get access to workers' compensation. Employers can't discriminate against employees on the basis of a number of protected categories. Independent contractors get none of those protections. They're in business for themselves, running their own business, and it's up to them to provide their own wages, their own benefits. Moving then towards taxes. Oh, and employees also qualify for, their wages qualify for unemployment, whereas income that independent contractors make does not go towards unemployment. On the tax side, employees are responsible for only the employee share of FICA taxes, which is Medicare and Medicaid and Social Security taxes. That's 7.65% of gross income, and then the employer matches that. So the employer is also paying 7.65% of gross income. On the independent contractor side, the independent contractor is responsible for the full 15.3% of those taxes. So there's a higher tax burden that comes with being an independent contractor as compared to an employee. And then with respect to bargaining, the National Labor Relations Act protects employees and gives them the right and protects the right to collectively bargain, which is one primary way that employees, through negotiations with hiring entities, can guarantee a set of acceptable worker conditions. Independent contractors do not have rights under the National Labor Relations Act. They cannot unionize. They do not have access to collective bargaining. It's up to sort of their negotiation power as an independent business to ensure that the labor contracts that they enter into are fair and equitable. I do see a question in the chat asking how independent contractor laws protect people who work through employment agencies. And if I assume you mean by employment agencies, you mean people who sign up with a company who assigns those workers to work at outside companies. So for example, we just had a case where a florist hired a number of temporary workers through an employment agency. Independent contractor laws protect those, what I'll call temp workers, because typically those temp workers are going to be considered employees of the temp agency itself. And so the temp agency is going to be responsible for ensuring that any job that those workers get assigned to get the benefits and protections granted by the Labor Code. And very often there's a strong argument that they may also be considered employees of the hiring entity or the contracting entity. So in the example, the florist, that's what we call a triangular relationship, where there's actually two hiring entities and one worker. It can get a little complicated on the legal perspective about if you do really have two employers, who's responsible for what sort of tax benefits and what protections. But at the end of the day, the Labor Code does recognize those temp workers as employees. And if they're being classified as independent contractors, that's likely an example of misclassification. If we go to the next slide, Aisha, that would be wonderful. Thank you. And in the slide after this, I will go over sort of how we recognize someone as an independent contractor or an employee, and that hopefully should make clear that those temp workers are in fact employees. But I also first want to talk about the stakes at play for employers and the state in worker misclassification. Ultimately, worker misclassification is what we call a cost shifting harm. Employers tend to save about 30% on total labor costs when they classify a worker as an independent contractor as opposed to an employee. Now, they may be paying the worker upfront the same amount of money, but because employers have reduced payroll taxes, they don't have to pay into unemployment, workers' compensation, or disability insurance, and they don't have to provide any benefits. The long-term savings add up over the course of that work relationship, so there's a strong economic incentive for an employer to classify a worker as an independent contractor if they think they can get away with it. On the flip side then, the state, who also has an interest in work relationships from the perspective of tax revenue and revenue towards social safety net programs, loses out on what most studies estimate to be billions of dollars a year in unpaid payroll taxes, in money that's not going to unemployment insurance programs or workers' compensation insurance programs. And so the net effects of this scheme are that employers are saving a significant amount of money and pushing that cost onto the state and onto workers by depriving them of a critical set of benefits and protections. If we could go to the next slide, Aisha. So how do we know? How do we know if someone is an employee or an independent contractor? Minnesota agencies and the IRS rely on what's called the common law test, which draws from principles that are found in just general agency law when one person is acting as an agent on behalf of another person. And that common law test looks at three big buckets of factors. The first is behavioral control. And the net idea of behavioral control is really, does the hiring entity exert control over what the worker is doing? I think of behavioral control as being split up across instructions and training. Instructions is the who, what, when, where, and how of the work. Who meaning, does the hiring entity care if the person they contracted with does the work, or can that person in turn contract with another person and say, hey, I have this job to clean an apartment building, I can't make it today, can you come and do that for me? If they can sort of subcontract in that way, they're more likely to be an independent contractor. Whereas if the original hiring entity says, no, it has to be you, they're more likely to be an employee. The what is, of course, what the job is. The more specificity that a hiring entity gives, the more likely that job is going to be categorized as work done by an employee. If the work is more general in nature, they're more likely to be an independent contractor. The same with the when. If a hiring entity wants someone to show up these specific days of the week between these hours, they're more likely to be an employee. Where if the contract is just for a net product and it doesn't matter when that work occurs, they can be done on the worker's own time, then they're more likely to be an independent contractor. The where has sort of been thrown into disarray with COVID, with lots and lots of workers who formerly were going to office buildings now signing on remotely. But typically, if a hiring entity cares about where a worker is, you have to come to our office and work on our computers. They're more likely to be an employee, where if there's flexibility in that regard, they're more likely to be an independent contractor. Even when folks are working from home remotely though, if you're supposed to be signing on to the hiring entity's VPN, if you're supposed to be working on their networks, that is a form of working in their space, even if you're in your own home. And then the how is how you get the work done, in what order you do the pieces. If the hiring entity cares about the specific order, you have to do things in a certain way, you're more likely to be an employee. Where again, if they care about just the end product and they don't care about how you get from A to B, you're more likely to be an independent contractor. I apologize, there's something very exciting outside for my dog. So if you hear the barking, hopefully it will, oh, it's another dog, in fact. So the news of the day. The second piece of behavioral control is training, which is, with these instructions, how much training is the hiring entity giving the worker? If you come in for a 2-week training and someone shows you the ropes, you're more likely to be an employee. Where, I'm sorry for setting off a chain reaction of dog barking. Whereas if the hiring entity just, again, contracts for the end product and doesn't provide any instructions, then you're more likely to be an independent contractor. A lot of courts and agencies recognize this behavioral control factor as sort of the predominant factor in determining whether someone is an independent contractor or an employee. And so this factor really clearly points towards one direction. It's very likely that that will be the end outcome, but courts will still tend to look at the next two factors to sort of confirm or nuance that decision. The second factor is financial control. And really that's looking at the financial situation of the worker as they're going through the job enterprise. That sort of breaks down into investment, expenses, and payment structure. By investment, I mean, has the worker invested in the tools of their trade? Do they own the vehicle that they're using? Do they own the equipment? Are they paying expenses on that equipment? So the second piece, are they responsible for vehicle insurance or for general insurance covering their work? And third, payment structure, how does the hiring entity pay them? Do they pay them on a per job basis? So again, it doesn't matter how many hours were put in, the hiring entity only cares about the product. If so, they're more likely to be an independent contractor. Or is it a pay per hour structure, in which case it doesn't matter how much product a worker accomplishes in a specific set of time, they're paid for that time. If that's the structure, they're more likely to be an employee. And then finally, the relationship between the parties is often sort of the least important because it matters less what the parties agree to, and it matters more how the law sees the relationship. But nonetheless, what the parties agree to can impact classification. And by that, we look at benefits. Does the hiring entity provide benefits like those guaranteed by the labor code? If so, more likely to be an employee. What's the permanency of the relationship? Is this a labor contract that extends for a long period of time or indefinitely? If so, more likely to be an employee. Or is it a one-off or short-term contract that would tilt towards independent contractor? And finally, overlap of purpose. And this is asking, is the job that's contracted for in the line of business that the company usually is part of? So for example, if I'm a restaurant, am I hiring someone to serve food to tables, or am I hiring someone to paint my outside wall? As a restaurant, I would be a food service enterprise, so someone who I hire to serve tables would be more likely to be an employee than someone who I hire one time to paint the wall outside of my building. One thing I want to note is that that's how Minnesota approaches the question of worker classification. It doesn't have a starting point. We don't assume whether you're an employee or an independent contractor. We simply look at these factors. But as of, I think, the end of 2018, which is the most recent 50-state survey I was able to find, 33 states do apply a form of a more restrictive test. It's called the ABC test. I won't go into that because it's less relevant for Minnesota, but the key difference is that ABC tests presume that a person is an employee unless it can be affirmatively shown that 1, 2, or 3 factors are present. And so that tilts the scales towards employees, and more workers in those states will be classified as employees than in states that don't apply that kind of presumption. If we could go to the next slide, Aisha. So now we're going to zoom in. That's sort of the overall landscape of worker misclassification. We're going to zoom in now to talk about how worker misclassification presents itself in the gig economy. The gig economy has sort of been all over headlines over the past few years. It's sort of every year more and more so. And what I mean, I'll offer a working definition of the gig economy, is a labor market that's characterized by the use of flexible, short-term, or on-demand labor to complete discrete tasks. When most people hear gig economy, they think of companies like Uber and Lyft or Instacart, and ride sharing and delivery services are the two largest components of the gig economy, but it also includes organizations, companies, and applications like Airbnb, space rental companies. You can rent office space through a number of gig economy companies. Also more generalized service companies. There's a platform called TaskRabbit, where you're not simply looking for a ride or delivery. It could be anything you want someone to come to your home to assemble IKEA furniture. You could go to TaskRabbit. And then more and more, we're seeing more sort of skilled and specific gig economy platforms. There's gig economy platforms now where you can get a doctor on demand, where you can get a mental health provider. We're seeing sort of traditionally kind of larger, more concrete pieces of the economy split up into more isolated gig work. What's the prevalence in the United States of gig work? Recent studies suggest that about 1/3 of all US workers do some gig work throughout the year to supplement their income. And the Federal Bureau of Labor Statistics recently estimated that about 10% of workers rely on gig work as their primary income source. So it's a pretty significant chunk of our economy. And as we know from the overview of worker misclassification, the stakes are pretty high in terms of whether an individual worker doing gig work is going to be classified as an employee or an independent contractor. Unsurprisingly, we're seeing more and more clashes between labor and industry over that gig work classification. I've just highlighted a couple of salient examples from the past year, but pretty much every month there's either a judicial or legislative development in this space. Looking back to March 2020, the New York State Court of Appeals, which is the highest state court in New York, found that food delivery drivers for Postmates were employees because Postmates, even though it was labeling itself as just a digital sort of conduit for those services, was exerting sufficient control over those drivers such that the behavioral control factor predominated and they should be considered employees. On the flip side, in November 2020, California passed Proposition 22. The history behind that is the California state legislature had previously passed a law called AB 5, which would have classified gig economy workers, most notably rideshare drivers, as employees by implementing one of those ABC tests. Of course, gig economy companies were not thrilled with that law, and so they poured hundreds of millions of dollars into a ballot initiative which reverses AB 5, formally cements rideshare drivers as independent contractors. It does offer them a small portfolio of benefits, akin to a watered down version of employment protections offered for employees. But the net effect is that moving forward in California, rideshare companies can safely classify their workers as independent contractors. Then just last week, on January 7th, the Federal Department of Labor formally adopted a rule that would relax requirements for independent contractor classification under the Federal Labor Standards Act. It's not yet certain whether that rule, even though it's been formally issued, will actually be adopted. It's not formally adopted until March 2021. The incoming Biden administration has strongly signaled that they're actually looking at adopting a rule that would go the other way and make it more difficult to call a worker an independent contractor, but that remains to be seen. So that's one issue that I'll be following pretty closely through my work. And then I want to end, of course, by highlighting the work that gig workers themselves are doing. There's some extraordinary organizing going on behalf of and with gig workers. Two primary organizing forces are groups called Gig Workers Rising and Gig Workers Collective. I would encourage folks to look them up just to see how gig workers are advocating on their own behalves. And gig companies are also starting to build up their own organizing and advocacy infrastructure. After Prop 22 in California, Lyft has started a multi-million-dollar super PAC in Illinois, trying to replicate the success of Prop 22 by passing a state law that would formalize rideshare drivers as independent contractors in Illinois. If we could go to the next slide. Thank you. So enter COVID-19. This is sort of the landscape of worker misclassification and gig economy work. COVID-19, like it did to the rest of the economy, threw a wrench into everything. It's impacted gig workers in three primary ways. The first is, again, like it did with many other sectors of the economy, led to a loss of economic security. Most saliently, diminished income. And that's sort of intuitive. The largest sectors of the gig economy are rideshare drivers. Fewer people needed Uber rides because most folks were staying at home. Delivery, on the other hand, the second largest piece of the gig economy, delivery drivers did see an increase in demand as more and more folks were starting to deliver things like groceries, but that doesn't make up for the loss in rideshare driving, and then also the loss of other segments of the gig economy, thinking about Airbnb, thinking about unskilled labor like that on TaskRabbit, although I would argue that assembling IKEA furniture might be classified as skilled labor, but fewer people were inviting those people into their homes to complete one-off tasks. So with that, we have diminished income, we have less predictable work, and then critically, because these gig economy companies were classifying their workers as independent contractors, when the work ran out and someone was no longer able to make a living off of that work, they weren't able to receive state unemployment benefits. The small carve out to that is that the CARES Act did include independent contractors in eligibility for unemployment. So some gig workers were able to access that piece of unemployment, but it's less than an employee would be able to receive, drawing on both the state and federal benefits. The second impact is a threat to health and safety. Remembering back to that expenses piece as the difference between employees and independent contractors. Independent contractors are responsible for their own personal protective equipment. They didn't get sick and safe leave for the most part. Gig economy companies weren't providing any increased hazard pay. And so for these workers to continue to make a living, they were having to put themselves quite literally in harm's way without often the support of the company that they nominally worked for. And then finally, increased competition. One thing that we saw is as unemployment applications were spiking because people were losing their jobs due to COVID, those folks were also turning towards gig work as they were either waiting for unemployment applications to be processed or if those applications were denied for any reason. So we were seeing increased competition for a smaller portion of available work. If we could move to the next slide. So what do we do with all of this? I want to leave you with two takeaways, one piece of concern, and one action item that you can all walk away with. The two takeaways, one, just on a general level, I hope you all leave understanding that worker misclassification has significant economic consequences for workers, for companies, and for the state. It's widespread and it's a big issue. Second is that COVID-19 has revealed the fragility of gig work's economic security, which is to say it's a direct consequence of classifying gig workers as independent contractors is that they lack access to the social safety nets that society has decided are critical for labor relationships. And because they lack access to those nets, they were particularly harmed by COVID-19. So third, a concern. We know that there's already economic pressure for employers to categorize workers as independent contractors. COVID has only enhanced that pressure as employers are trying to reconfigure their business models to stay alive. So there's now increased pressure to either reclassify W-2 employees as independent contractors, that would be misclassification, or to shift towards a gig work model for some of their labor needs, to forgo the need to have permanent employees and instead to contract with platforms for one-off needs as those arise, that would rely on misclassification to the extent that those gig platforms are classifying those workers as independent contractors. And so for an action item, there's an easy way for workers to sort of advocate for themselves in terms of classifying themselves as independent contractors or employees. It is ultimately up to an employer to issue either a W-2 for an employee or a 1099 for an independent contractor, but the IRS runs what's called the SS8 program, and it allows any worker in the entire country or any service provider on behalf of a worker to submit a relatively streamlined form. It's a series of about 40 questions that runs through those three buckets: financial control, behavioral control, and type of relationship. And by submitting the form, the IRS will analyze the facts and circumstances. One thing to note, it's not anonymous, so they will contact the hiring entity for a response. But after analyzing the circumstances, they'll issue a formalized determination of whether a particular worker should be an independent contractor or an employee. So that can be a really strong start for a worker or a service provider who's questioning whether a worker is properly categorized, is to get the IRS involved and get some sort of formal determination on the books. One thing to note with that specifically is that VITA sites can be a really important place to either start that inquiry or file that SS8 form. MMLA, Mid-Minnesota Legal Aid, is partnering this year with Prepare and Prosper to work on their SS8 filing. They typically file about 15 a year in the state of Minnesota, and so we'll be partnering to see if we can scale that up to identify more cases of misclassification. So if you or your clients are working with VITA sites across the state, that's an issue that they could bring to their tax preparer, and tax preparers would be well situated to look into the SS8 process. Next slide, Aisha. And with that, I want to leave you with the idea that if you have questions about how a particular worker should be classified, or you think that you have a referral, you think that you're working with a worker who's been misclassified and you're not quite sure what to do with that, Mid-Minnesota Legal Aid would welcome hearing from you. So please feel free to reach out either to Aisha or myself. Our contact information is there on the screen. We would be thrilled to just talk through the facts of the particular case you're working with, or if the circumstances call for it, to take a formal referral and to represent that worker through the misclassification process. And with that, I'll wrap up my piece of the presentation. Thank you all so much for listening. And I think we have about 12 minutes, give or take, to answer any other questions that did come up. I do see the most recent one, will we receive a copy of this recording? And the answer to that is yes, but Mary Jo can tell you exactly how you'll receive that.
So yes, the recording will be sent out afterwards along with the PowerPoint, and then the resource guide I'll put in the chat again, but I did put that in there, and then the evaluation that I'm actually going to put in right now. But we're not done yet. If you have questions, please, you can put them in the chat right now, or you can unmute if you'd like and ask your question as well. It's always the uncomfortable silence, right? Waiting for. I agree. Thank you, David. It was a lot of great information. I am going to put in the chat also our next webinar on January 26th. And then that's the Zoom registration link. We'll also send that out if you're not able to grab that in the chat before you leave. So Keely has one question. Are there cases where people have to advocate to even get a 1099?
That's a great question. The answer is yes. The worker misclassification that I was talking about presumed that the worker did in fact receive a 1099 from their employer. We also have cases of misclassification where a worker is paid under the table, oftentimes in cash or even by check, but then they don't receive tax information at the end of the year. A huge portion of that income goes unreported by workers themselves. That is also a form of misclassification. It would be misclassification as neither an independent contractor nor an employee. People can advocate with their employers to receive the 1099 or W-2 as appropriate, or again, could file an SS-8 with the IRS, even if they didn't receive a 1099, to figure out which of those forms they should properly receive.
Any other questions? We can hang out a little bit too if you all have things that you want to ask, but thank you. The slide is up. We want to thank Aisha and Eric for such a wonderful presentation. It was great information and just spot on to some of the things we're all thinking about, right? And kind of anticipating some of those questions that we may get, not only from the families and communities we serve, but also ourselves as well. So, and the evaluation, I put it in there twice because we really would love for you to fill that out. We want to make sure that these webinars are helpful to you, that they are informative, and that we are providing the information that you need. And so by filling out the evaluation, we'll be able to adjust and adapt future webinars. So thank you so much. We appreciate everyone's time. Stay safe, and we look forward to seeing you all on the 26th. Thanks so much.
Well, thanks so much, folks. I'm gonna hop off. It looks like everyone else is hopping off too. Aisha and Eric, thank you so much. What a wonderful presentation. Really impressed by your depth of knowledge on these issues.
Thanks so much, David. It was good to chat briefly.
Right. Take care, everyone.
Yes, thank you.